Mr. AG here, the Asian guy. Monday morning. Markets are open. Silver is sitting at $83.83. Basically flat. Moved 0.08% from Friday's close. And I already know what most people are thinking. Nothing happened. Silver did not move. Time to look at something else. And that is exactly the wrong read. Because when silver does not move on a morning like this one, when the Strait of Hormuz is disrupted, when oil is surging, when the dollar is ripping, when non-farm payrolls just printed the worst number in years, when the Fed is frozen at a 95% probability of no rate cut, and silver sits perfectly still at $83.83, that is not boredom. That is compression. That is a market absorbing every piece of information, every headline, every data point, and refusing to break in either direction. And compression resolves. It always resolves. The only question is which direction and when. I am going to walk you through exactly what the data says about that resolution. Every number sourced. Every data point you can verify yourself. That is how we operate here. Before we get into it, drop a G in the comments. One word. Let me know you are locked in this Monday morning. And tell me where you are watching from. Drop your city or country. Tokyo, Manila, Jakarta, Singapore, Sydney, Karachi, London. Wherever you are, I want to see this community on the map because the analysis we do here does not care about time zones. It cares about being right. If you are not in the WhatsApp community yet, link is in the description. That is where I drop real-time analysis when things are moving too fast for a full video. Join it and follow us on X, formerly Twitter, for breaking alerts between uploads. Links below. Now let us read the tape. Starting with the gold to silver ratio because this is the number that most people glance at and very few people actually understand. On Friday, the ratio stood at 61.43. This morning it dropped to 60.96. That is a compression of almost half a point in a single session. And while half a point sounds small, the direction matters far more than the magnitude. The ratio is moving down. It has been compressing from the extremes above 80 and 90 that defined recent years. And in the precious metals complex, when this ratio is falling, it means silver is outperforming gold. It means capital is rotating from the safer, more liquid metal into the more volatile, higher beta metal. It means the market is getting more aggressive, more confident, more willing to reach for leverage. That rotation does not happen at market tops. It happens in the acceleration phase of bull markets. Every major silver move in modern history has been preceded by sustained ratio compression. 1979, 2010, and right now, the ratio was above 80. Now it is below 61. That is a trend, and trends in this ratio tend to overshoot. They do not stop at fair value. They blow through it. Historical blow-off targets for this ratio sit in the 40s, the 30s, and in extreme cases below 25. If you understand what that math implies for silver's price at gold levels of 5,000, 6,000, 7,000, you understand why an $83 silver price is not expensive. It is early. Now the dollar and the Fed because these two are driving the short-term price action and you need to understand the mechanics. The CME FedWatch tool is showing a 95% probability that the Federal Reserve holds rates unchanged at the March meeting. 95%. That is near certainty. The market has completely abandoned any expectation of a near-term rate cut. And that expectation is supporting the US dollar, which is gaining strength against every major currency. A stronger dollar typically weighs on precious metals because it makes them more expensive in every other currency on Earth. That is the short-term headwind that silver is facing right now. It is real. It is measurable. And it is why silver is not at $88 this morning instead of 83. But here is where the picture gets complicated in a way that favors silver on a medium-term basis. The non-farm payrolls report that just dropped is a disaster. The U.S. Bureau of Labor Statistics reported that payrolls fell by 92,000 in February. Fell, not grew slowly. Fell. The market was expecting an increase of 59,000. The prior month was revised down from 130,000 to 126,000. And the unemployment rate climbed to 4.4% from 4.3%. This is a labor market that is cracking, not collapsing yet. Cracking. And a cracking labor market combined with rising inflation from an oil supply shock is the definition of stagflation. The Fed cannot cut into rising inflation. But it also cannot hold rates at current levels indefinitely while the labor market deteriorates and the economy slows. That tension, that impossible position, is what creates the conditions for precious metals to thrive. Because when the Fed is trapped, when there is no good policy option, capital flows into assets that exist outside the policy framework. Gold, silver, hard money, real things. And that NFP number has another implication that the market has not fully processed yet. If the labor market continues to weaken, the dollar's current strength becomes unsustainable. You cannot have a strong dollar on rate expectations when the underlying economy is producing negative payroll prints. The dollar is strong right now because the market is pricing inflation-driven rate holds. But if the next two jobs reports confirm that February was not a one-off, that the labor market is genuinely deteriorating, the narrative shifts from higher for longer to the Fed is behind the curve and needs to cut to prevent a recession. That narrative shift weakens the dollar. And when the dollar weakens, silver reprices higher immediately because the headwind becomes a tailwind. The question is timing. And timing in this environment is driven by data. This week we get CPI on Wednesday. That print will either confirm the inflation fear or temper it. If CPI comes in hot, the dollar strengthens further and silver stays compressed. If CPI comes in soft, the dollar pulls back and silver catches a bid. Either way, the resolution is coming. Now I want to address something that BCA research published because it directly affects how you should be thinking about the industrial metals complex and silver's place within it. Ruqayya Ibrahim, the chief commodity strategist at BCA Research in Canada, issued a warning about copper. She said that copper's recent rally has been primarily driven by speculative demand in Asia, physical asset trading, and overly optimistic expectations that copper could become the next gold. Those are her words. She explicitly called it a potential valuation bubble. And she said that if global economic growth turns out weaker than expected, copper prices, which lack strong fundamental support, could experience a pullback. That is a significant statement from a major research house. Copper has been one of the best performing commodities this year and one of the most crowded trades in the institutional space. If that trade unwinds, if the speculative positioning in copper reverses, the ripple effects hit the entire industrial metals complex, including silver. And this is where Ibrahim's analysis gets particularly relevant for our purposes. She said that in terms of precious metals, she favors gold over silver. Her reasoning is that silver has a strong industrial component and is therefore more vulnerable if economic growth slows, while gold benefits more directly from safe haven flows. That is a fair argument, and I want to engage with it honestly, because at Mr. AG we do not ignore the bear case. We confront it. Silver is approximately 50% industrial in its demand profile. If global growth slows, if manufacturing contracts, if copper pulls back and the industrial complex reprices lower, silver's industrial demand base does soften. That is real. That is a risk. I am not going to pretend it does not exist. But here is what that analysis misses. Silver's industrial demand story and silver's monetary demand story are two separate forces. And in every inflationary supply shock environment in modern history, the monetary demand force has overwhelmed the industrial demand weakness. The 70-decade proved it. 2008 through 2011 proved it. When inflation is running, when currencies are under pressure, when geopolitical risk is elevated, when the monetary system itself is under stress, silver stops behaving like an industrial commodity and starts behaving like a leveraged call option on monetary chaos. Its beta to gold increases. Its volatility expands. And the ratio compresses as capital floods from gold into silver looking for the higher return. Ibrahim is correct that in a normal slowdown, gold outperforms silver. But this is not a normal slowdown. This is a war economy with blocked shipping lanes, a frozen Fed, negative payroll prints, and a gold-to-silver ratio that is already compressing from multi-year extremes. In this environment, silver's monetary identity asserts itself. And when it does, the industrial demand argument becomes secondary. Let me connect the Strait of Hormuz because this is the engine driving everything right now. The supply chain disruptions through the strait are stoking inflation concerns globally. A fifth of the world's oil normally transits through that single choke point. When that flow is impaired, it does not just affect oil. It affects natural gas, liquefied natural gas shipments, chemical feedstocks, refined products, and the shipping insurance markets that price risk for every vessel in the Persian Gulf. Matt Gherkin at BCA Research pointed out that Japan, which relies heavily on imported energy, could see significant stock market losses if external shocks continue. Japan's Nikkei has been one of the strongest performing indices this year. If that starts reversing on energy cost pressures, you have another risk-off catalyst that drives safe haven demand for precious metals. The Hormuz disruption is not just an oil story. It is a global growth story, a global inflation story, and a global capital flow story. And silver sits at the intersection of all three. Now here is what I want you to sit with. Silver is flat this Monday morning, $83.83, up 17.93% since the beginning of the year. The gold to silver ratio just dropped below 61. The Fed is frozen. Payrolls just printed negative. Oil is surging on a real supply disruption, not a speculative one. A major research house just warned about a copper bubble, while the same research house is bullish gold. And the strait that handles 20% of global oil is compromised. All of that is happening. And silver is sitting still, compressed, absorbing, waiting. The question is not whether silver moves. The question is whether you are positioned before it does. Because silver does not give warnings. It does not send invitations. It sits flat for days, sometimes weeks, absorbing pressure on both sides. And then it moves so fast that by the time the chart signals the breakout, the best entry is already gone. That is silver's nature. It punishes those who wait for confirmation and rewards those who read the compression and position accordingly. I am not telling you what to do. I am telling you what the data says. And the data this Monday morning says compression, ratio compressing, volatility compressing, narrative pressure building from every direction. Oil, dollar, federal labor market, geopolitics, all converging on a market that is sitting perfectly, unervingly still. Watch CPI Wednesday. That is the catalyst. If it comes in hot, the compression extends. If it comes in cool, the release begins. Watch the gold to silver ratio. Below 60 is the next level that matters. Watch the dollar index. If the NFP data starts weighing on it later this week, silver's headwind disappears. Watch copper. If BCA's bubble warning starts playing out, watch how silver responds. Does it fall with copper on industrial demand fears, or does it diverge higher on monetary demand? That divergence, if it happens, tells you everything about which silver you're dealing with. Industrial silver or monetary silver. Commodity silver or crisis silver. Every source I reference today is public. FX Street Silver data is live on their site. The CME FedWatch tool is updated in real time. The BLS non-farm payrolls report is published and archived. BCA research commentary was reported through ETSI. Verify everything. The people who check do not get caught off guard. If this gave you clarity on a Monday morning when most of the market is confused, share it with one person who needs the context. That is how we grow, not through hype, through analysis that holds up. Make sure you are in the WhatsApp community. Link in the description. Follow Mr. AG on X for breaking alerts. And subscribe because the next 30 days in silver are going to separate the people who read the compression from the people who chased the breakout. One question to carry into this week. Silver is flat while everything around it is on fire. Is the market ignoring silver? Or is silver ignoring the market? Think about which one of those is more bullish. Stay sharp. Invest with logic, not noise. This is Mr. AG, the Asian guy. I will see you in the next one.